Well, thank you very much, everybody, for joining us this afternoon. We really appreciate you being so generous with your time. We realise it's a week of hyperbole and conjecture and stress for your clients in anticipation of what will be, I'm sure, another blockbuster budget, and they'll be wanting your time. So thanks very much for taking the time out to join us this afternoon. My name's Paul Devine. I am the Business Development Manager for Blackfinch, covering Scotland, Northern Ireland, Cumbria and the Lakes. And I'm joined by my esteemed colleague, Dr. Nic Pillow, Investment Director in the Ventures Division. Just a bit of housekeeping. There is a Q&A function, so any questions that you may have, please use the Q&A function in the Zoom chat. If time permitting, we will get to those at the end. If not, we will revert to you individually answering your questions. And there will also be a survey at the end of the presentation as well, so be much obliged if you could fill that in and give us your honest feedback. And there's only one way that we can improve to better ourselves and our value to you, and that's through candid and constructive feedback from yourself. So if you could do that, that'd be absolutely great. So important information: Blackfinch are a regulated business through the Financial Conduct Authority, and anything we say today should not be taken as financial advice or tax advice. This is a presentation for financial advisors and financial professionals. So if you would like to share any of this content with any of your clients, please let us know. We'd be more than happy to include all the salient and relevant risk warnings in order for you to make it client facing for your clients. In regards to risk, these investments are classed as high risk by the FCA, and there is a chance that you could lose all your money. You're unlikely to be covered by the Financial Services Compensation Scheme if anything were to go wrong with the investment. And even if you were to get any money back, then they are classed as illiquid, so you wouldn't get them back as tenuous as you would if you were sharing in cash and shares on a listed business or in a named stock. So there is a bit of liquidity as a concern. In terms of diversification, it is good and standard practice to diversify all your clients across different tax wrappers and different investments. And also the investments can go up and can go down. So learning objectives today, if we summarise the four that we are looking at. So we want to look at the structural differences between VCTs and EISs. We want to explain how deployment differs between the two. So at the end of this, you should be able to differentiate between both and how they do deploy capital. Identify clients suitable for VCTs and EIS, and I'm sure that there is a far greater consideration to both now in light of the last budget, so it'd be good to identify which clients could use VCTs and EIS investments, and outline the Blackfinch approach to our selection of different companies, our investment process, and the area that we operate in within our VCT. So that's the learning outcomes and learning objectives for today. So the first learning objective is the structural differences between VCT and EIS. So first off, VCT itself, your clients who want to invest in a VCT, they would be buying shares in a listed company on the London Stock Exchange. By doing so, they just by proxy get exposure to a suite of underlying companies. Sometimes it's 20, sometimes it's 30, it could be 40, or it could be 50, depending on the VCT that you invest with. So you are buying shares, or your client are buying shares on a vehicle on the London Stock Exchange. In terms of deployment for a VCT, say your client wants to invest £100,000. By doing so, they invest in the VCT and all that money is deployed in the one go, which makes tax efficiency more immediate than it would be in an EIS. So all one share certificate, and that would allow your client to claim the tax relief on that lump sum of £100,000. In regards to liquidity, yes, this is a closed-ended vehicle. It is listed on the London Stock Exchange, and there is three ways of facilitating liquidity. So the first one is the secondary market. Now, let's not kid ourselves on. There isn't much of a secondary market for VCTs because you don't get the tax relief by buying a secondary VCT on the secondary market. The second of all, you can use the registrar, which is either Computershare or City. They can buy the shares back. Or third of all, and the most popular way of doing it, is through the share buyback scheme that investment managers offer. It's not mandatory or obligatory, but we do offer it as part of the investment. And we do that at a discount to the prevailing NAV at that time. And that is the most popular and most time-effective route for people to get liquidity in their VCTs. So that is broadly the structure of a VCT and what your clients are buying into and how capital is deployed and how tax efficiency is claimed in a VCT in regards to it all coming at the one time. In an EIS itself, the differentiating factor is you're not buying shares on a listed business. You are indeed buying shares in the underlying portfolio companies. So you become a shareholder in a portfolio of 6, 7, 8, 9, 10 companies up to 14, depending on who you invest with as an EIS provider. So you are buying shares in that underlying company and becoming a shareholder. And that's why business relief is applicable as one of the tax benefits of holding an EIS investment. In terms of deployment, say the same £100,000 that you want to, or your client wants to invest, is invested into an EIS. That's actually split up typically over a 12-month time frame. Some have protracted time frames, it could be up to 18 months, but generally it's about 12 months to deploy a sum of capital over into an EIS. So say it was £100,000, you want to invest that across 10 different companies, that's £10,000 into each individual company. One could happen this month, one could happen in a couple of months' time, so on and so forth from April to April. And then you would get tax efficiency at different times. So tax efficiency on the first £10,000 would occur at the first tranche, then the next £10,000 on the next tranche. So it's unlike a VCT where it's all done at the one time. An EIS, the tax efficiency occurs at completely different times over a potential 12-month time frame. We are quite fortunate that we have the ability to take funds and applications right up until about mid-March and have it deployed before tax year end, subject to the appropriate waiver, which means that your client might end up with a more concentrated portfolio. But typically we look to invest in 10 to 14 companies. Again, Nick will talk more about this as we go through the presentation. In regards to liquidity, this is the highest risk that you can get in terms of liquidity. You're unlikely to get your money back until one of a number of things happen. So a company either merges, it either IPOs, it either fails, and then at that point you can claim loss relief. So those are the varying scenarios where you can get your money back. So it's just something to bear in mind between VCTs and EIS. One is completely and super liquid. The other one does have a route to liquidity, but it's still not the same as a main market or a public market investment. So what is a VCT itself? So a VCT was brought around in 1995, so they're 30 years old. So they're not so new, they're not so niche and bespoke anymore. We're definitely seeing them become part of the mainstream, that's for sure. And they were brought around to create and stimulate growth in the British economy, to help fledgling startup businesses get a nice foothold and a good route to success. And in doing that, the government brought around some really beneficial tax benefits. Again, I must stress that when you do these investments, it should be for the investment opportunity and not so much for the tax reliefs. We don't want the tax tail wagging the investment dog, but I suppose we can't really we can't get around the fact that they do offer some really good tax benefits for clients. So they are as follows. So 30% income tax relief up to £200,000. So the maximum tax relief that you can claim in a year is £60,000 in the current tax year only. Any growth in the VCT is free from capital gains. So if you invested £100,000 and it grew to £150,000, not only would you be one of the best VCT investors ever in picking the right VCT, it means that that entire growth is not subject to tax. They are classed as an income, or people see them as an income generator. So generally 5% is the target dividend across the market. Some are higher than that, but generally 5% is the general target for dividends. But to get all those tax reliefs, you have to have held your VCT for 5 years. So it's a minimum holding period of 5 years. But you don't have to sell at the end of 5. You can keep it in perpetuity if you really want and keep the dividends coming in. So in terms of the tax relief itself, what do you get it on? So tax relief is only applicable on new shares. As I said earlier in the presentation, that is why there isn't much of a secondary market for VCTs, because you don't get the generous tax break by buying VCTs on the secondary market. Again, there is the minimum hold to get that tax relief. And if you do decide that you want to sell your VCT within that time, then HMRC will claw back the tax that you have already claimed back on your VCT. Notwithstanding that, you can't claim any more than the income tax liability that you have. So I'll give you an example of that. If someone was in the fortunate position to invest £200,000, the maximum into a VCT to claim back £60,000, if their tax burden for the year is only 30, then they would only be able to claim a maximum of £30,000. So you can't actually claim more than the income tax burden that you have. So that's something just to bear in mind. I mean, somebody could do that if they really wanted. They could subscribe to £200,000 if they really see a fantastic investment opportunity, but they will only get if their income tax burden is £30,000 worth of relief. So why would you invest in a VCT? Sounds good, the tax relief, that's great. As I've already said, you don't want the tax tail wagging the investment dog. So from an investment standpoint, it's actually very complementary to the existing portfolios that clients may have with their GIAs and their ISAs, etc. We've seen that in the past 4 years, VCTs are becoming more popular. It's raised over £4 billion in the past 4 years, which is quite extraordinary when you look at where it's came in the past 30 years. It was launched at 20% relief back in '95, and that continued on for a while. And then the tax relief changed to 40%. I believe it was years 2004, 2005. And that was the highest raise then, 756 million. It was raised back 2004, 2005. But you look at it now, it has ramped up, became more mainstream. And from 2020, which was in the height of COVID, since then, there's been 4 billion raised into these types of investments. So people are seeing that there is value to be had and some good diversification to be had in the private markets through these venture capitalist trusts. It also gives you access to a wide range of investment strategies. We all do something different out of all the managers. We all have different approaches to the market. We all have different geographies that we like to invest in, whether that be regional, whether it be concentrated to one area. But also it helps, if you want to help grow the UK economy, which is in a bit of a bind at the moment, it is a way of supporting that young, could be tech, could be hospitality, those young businesses, help them grow and be a benefit to the UK economy. So those are some of the compelling reasons as to why you should invest in a VCT or why you could consider investing in a VCT. So who would be investing in a VCT? What would they be doing it for? Where and when? So one of the most dominant demographics of VCT investors are business owners. I'm sure it's not lost on anybody on the call that if you have too much surplus cash or non-working capital in the business, then HMRC can see that cash as an accepted asset, which means that could impact on your ability as a business owner to claim business asset disposal relief. And it could also impact the rate of inheritance tax or business relief that you get from your business value. It can be taken off if it's at a certain percentage. They can take that value off of the business. So in order to reduce the surplus cash holding within your business, VCTs are a really good way of taking money out of the business in a tax efficient manner. And you could use that for anything else. And we'll talk about that in a client scenario in a wee minute. Landlords can also use it. So they might not be contributing to a pension of their own. They might see the assets that they hold as the pensions that they will rely on in retirement. But in the meantime, they're getting a rental income from these assets and they'll be paying tax on that rental income. So another way to reduce the amount of tax that they will pay on that, they could use VCTs. High earners, those who have a tapered personal allowance, earning over £100,000, could invest in a VCT, and that will help get some tax relief for them as they go into the 62%, 60% marginal rate of tax as they start to lose their personal allowance. Also, clients who have been subject to the tapered annual allowance, who can't contribute more than the 60 grand a year, and they are subject to the tapered annual allowance, you could use VCTs as the next cab off the rank for tax efficiency. But more and more we're seeing from the last budget, retired clients are actually looking at VCTs either to draw down on their pension, take more from their pension, and use VCTs to offset the tax that they will pay. But also people who have been made redundant. That's another demographic of people that is very rarely ever explored or spoken about. People who are potentially at C-suite or senior management level, who are being made redundant. Maybe they are getting a settlement which is over the £30,000. The first £30,000 obviously is tax-free, and anything above that you're subject to tax. Then you could use a VCT to offset that, or potential people who are relinquishing a bond. If there's any gain in a bond, there is income tax that they will pay if they're a higher rate or an additional rate tax band payers. VCTs can actually offset the income tax burden that they would have when they relinquish their bond. So, as I said earlier, business owners use VCTs in order to withdraw money out of the business more tax efficiently to draw down surplus cash in the business. So how would that work in actuality or in practice? So let's say in year one that somebody wants to take out £50,000 from their business because they're building up too much surplus cash in the business. Then typically a business owner will pay themselves the tax-free amount, £12,570. They'll pay themselves that as a salary, and then they will top the rest up with dividends up to the threshold of basic rate of tax at 8.75%. If they want to take a further £50,000 from the business, they're going to incur a 33.75% tax bill. That equates to about £16,500 there or thereabouts. By taking that £50,000, investing it into a VCT, they'll get £15,000 tax relief, which will net off against the £16,500 of tax burden that they would have, which leaves them with a negligible amount of tax to pay. But notwithstanding that, they would have their dividend for that year as well on that £50,000. So they could end up in a net positive position at the end of the day. So that's year one. You do the same in year two, 50,000 out of the business, £50,000 into a VCT, £15,000 tax relief, and then the dividends. If you do the same year three, year four, and year five, if you do a VCT from year one to year five consecutively, then you've pretty much done VCTs for life at that particular point. When it gets to year six and you want to take £50,000 out of the business, you don't actually have to put that £50,000 into a VCT. You could take year ones because it's been held for that minimum of 5 years. You could take year one's £50,000, and depending on the value at that time, you could invest that into another VCT in year six and start to recycle that bank of £50,000 for the past 5 years into year six, year two into year seven, year three into 8, 4 into 9, 5 into 10, and the £50,000 from year 6 to 10, you're not having to invest into a VCT in order to get tax efficiency, because you're going to get tax efficiency on money that you've already had tax efficiency on. So you can use that for whatever you like. So it's just a good way of making money or taking money from the business more tax efficiently. In regards to the Blackfinch Spring VCT, ours is an evergreen offer proposition, and it's currently open at the moment. This is broadly the details, so £3,000 minimum. The misnomer is that these are for super high earners. It's not the case. We have lots of clients who do the minimum or just above the minimum, and we are looking to raise £20 million with an over allotment of £20 million. So again, if anybody is looking for any illustrations or want to talk over fee details post webinar, please feel free to reach out to your local BDM or myself. We do have a current early bird discount, which is 1% discount on the initial fee up until the 15th of December, 5 o'clock. So that's cleared funds and applications by then, and your investor would be applicable for the early bird. And any existing investors will benefit on top of that of an additional 1%, which they can use in conjunction with that. So again, just something that's open and might be worthy of consideration. I suppose we'll see what happens after this budget next week. So what's an EIS? EIS, as we said, structurally different, completely different proposition and more high risk. Again, they have a longer track record. They've actually been around since 1994. And again, the same reasons, brought around for the benefit of British startups to help us help and grow the economy and give these companies a chance. So, because they are earlier stage, EIS is investing at an earlier stage in a VCT, there is slightly more risk, higher chance of failure. But again, in order to deal with that, there is a wider or more greater tax incentive for the investor. So there's a 30% income tax relief like VCTs. The difference is you can actually carry back from the year before. There is tax-free growth as well. There is loss relief, and we'll talk about that at the end of in the next couple of slides. We'll give you an example of loss relief. So it's something that's often overlooked. Capital gains tax deferral, that's where I see clients using it most, is they want to get out of something that they don't want to be in anymore, but they're going to incur a gain on that. Using an EIS can certainly help dampen or minimise the burden of capital gains. Inheritance tax relief, again, we are having more conversations with people who are exploring EIS for IHT mitigation. Again, another benefit, and the reason people get it is because they are direct shareholders in the underlying portfolio companies that they have, and as per the business relief rules, that would, at 2 years and at the point of death, would qualify them for IHT relief. Again, the maximum permitted prescription or investment is £1 million, and a knowledge-intensive one you can do £2 million. So again, there's some really chunky benefits there, some multiple layers, and again, you would use an EIS over a VCT if you did have a multiple of these tax burdens. Again, like VCTs, this is only applicable on new shares. There is a clawback if you sell the shares within the 3-year minimum holding period, and it is worth consideration that while 3 years is the minimum holding period, it's in extenuating or extreme circumstances that you would realise any returns at that 3-year period. There has been instances where either a good offer has come in and EIS companies have been sold at the 2.5-year mark because it's just been an offer you couldn't turn down. And at that point, HMRC would claw back any of the tax relief that has been paid at that point. There is, in some instances, EISs may lose their approval, therefore HMRC will come back and claw back any of the tax relief if it's lost within 3 years. Another thing to bear in mind is that the maximum tax relief that you can get is £300,000 in any 1 year. And like VCTs, it can't be negative. So again, if you had an income tax bill of £100,000, there'd be no point in doing the £1 million because you don't have a £300,000 income tax liability. So again, like VCTs, who would they be used for, where and when? So again, as I suggested earlier, this is to get you out of an investment that you might not want to be in anymore. If you don't want to be in a GIA portfolio, if you want to sell a property, if you have gains elsewhere, you can use an EIS in order to get out of anything that you don't want to be. You might actually want to use it for a GIA where the seeding provider, you can't do an interspecies transfer. I've had that before, so it's again something that you could use an EIS for sure. The same clients as a VCT, yeah, broadly, but I think an EIS investor definitely understands that these are completely illiquid, that there is no real proactive route to get your capital back where there isn't a VCT. You can use a share buyback scheme. An EIS doesn't have that facility. You're only getting your money back if the company fails, so you have to claim loss relief. If it IPOs or it merges, and that's the routes that you would get your capital back. So yeah, same as a VCT, but somebody who understands company structure, probably an entrepreneur, and somebody who has an additional IHT liability as well. This dovetails into the next point. Sophisticated high net worth investors, absolutely. So they will understand that they can do without this money. They don't really look at this money as capital that they need anytime soon, and anything that they get from it is a bonus, but they are just glad to get the tax relief on it. And generally, where you have multiple tax burdens, EIS is absolutely the go-to for that for sure. If we look at EIS popularity over time, this is only from 2005, but you can actually see that it's grown exponentially in the number of subscriptions until 2022-23, process from the government itself. Again, you can see there has been a rise in popularity and a spike right in the middle of COVID as well, and just coming out the back end of it. We're seeing that people are looking at these vehicles because they are providing a diversified benefit to them, and all these tax benefits really kind of come into play. Again, fees and details. The minimum investment for us is £10,000. Our target return is 3%. But again, Nick will talk further about our company selection and what we actually look for in these companies. But again, looking between both vehicles, the VCT and EIS, absolutely EIS is a growth vehicle with a VCT as an income generating vehicle. So again, If you want to know any more details about fees and anything about the structure, then please reach out to myself or reach out to your local BDM, and they'd be happy to talk you through the finer details. But I did say that I would give you an example of loss relief, again, an often overlooked benefit of investing in an EIS. So for talk's sake, your client invests the minimum, they invest £10,000. The actual cost to your client is actually £7,000 because the book cost is £7,000. You're getting your 3%, your £3,000 tax relief on that. So let's just say that £7,000 is written down to zero. Your clients can actually claim at their marginal rate, the £7,000 times their marginal rate will give them £2,800, and they can put that against their income tax bill for the year. So when you actually add that up, you're getting 2,800 back. You've had £3,000. So your actual net loss on that investment, if it's written down to zero, is £4,200. So it's a 42% loss, not 100% loss. So again, there are ways of using things like loss relief to dampen and minimise the risk and minimise the impact of an investment going to zero. Again, we have further case studies that we can send you at the end of this presentation. But without further ado, I would like to pass you over to my esteemed colleague, Dr. Nic Pillow, who will talk you through the investment strategy for the Blackfinch Ventures division. Nic, over to you.
Thanks, Paul. Yes, so I've been with Blackfinch for 6 years as part of the Ventures investment team, almost from the very beginning of that team. But before that, my background was actually in the types of company that we now invest in. A long time ago, I did a PhD in computer vision, which was pretty unusual back in those days, not useful for a great deal because it was still very primitive. But clearly, a lot more mainstream these days. I then worked through a series of tech startup businesses and the large companies that bought them out, including Nokia. And I started very much on the technical side, but then moved much more over to the business side in those later businesses. And then I co-founded and ran my own tech startup in the few years before I then joined Blackfinch. So I've seen it from both sides, the investment company, the investment side and the actual early stage tech business itself. And that's not untypical for the team that we've got in Blackfinch. Quite a few of us have actually started and run our own tech startups. So to give another example, Richard Harley over here on the left of the slide there, he founded a company when he was at university. It was an education technology company, but with a big market, and he scaled that over several years and sold it very successfully. And we're then doing angel investing before he joined Blackfinch a few years ago. And I won't talk through all the others, but quite a few of us, as I say, have that experience as founders. We've also got very good technology experience. 3 of us have actually got PhDs. We've been involved in various types of actually mainly engineering research. And then we have the finance experience as well. So Kim, for example, in the center there, who leads the work on our new deals. Her background was in mergers and acquisitions, which, as you can imagine, is particularly useful when we're then looking to sell companies at the end of their journey through our portfolio. So it's that sort of real, I think for us, unique mix of technology experience, startup experience, where we've been the founders ourselves, and finance that we think really makes this work for us. And you can see how we're structured as well. We have different people leading in different areas of the business. But one thing I should stress is that we do work very collaboratively together as a team. And I'll say a bit more about that when we talk about the process. But just because Kim's leading on these new deals, as I mentioned, that doesn't mean to say that Richard and I aren't. We are all involved in all the decisions about taking companies through our process where we're making the decisions about which companies to invest in. We are all involved, along with Richard, in supporting portfolio companies. So I, for example, and the board observer with 3 of our portfolio companies. And so we're all helping support these companies and choosing which ones to invest in. And it's not just us. We also have a network of now over 100 venture partners who are people with particular industry or business experience that can help us. And it's these people that we appoint as directors on the boards of our companies. So I mentioned I'm the observer on 3 companies, but I'm not the director. And in almost all cases, not quite all, but almost all cases, we have the right both to an observer and a director. And the director we appoint not just to monitor what the company is doing, but to add real value. And so they could be, for example, someone like Geraldine here, who founded her own company, took it to the US, sold out to private equity, and she is brilliant at marketing. And so if we appoint her to the board of a company, as we've done in a few cases, she will work with them intensively, not just in board meetings, but outside that as well, with one-on-one meetings, helping them define their marketing strategy. How do they recruit someone to run a marketing team when they don't have the experience to be able to judge if the candidates are any good? And so that business experience, in her case, in terms of marketing, really invaluable for companies that need that. In other cases, it might be industry experience. And so another example, Libby Chambers on the right-hand side there, her industry is finance. And she's on the board of one of our companies. In fact, one Currency, I'm going to mention it later. It's a fintech, financial technology. She also sits on the boards of Wise on TSB. So she's intimately involved in that industry, and it is, and again, that's one of the companies I'm the observer for, and I see her in action, and the experience she's got that she can bring to bear is really, really valuable. So, as I say, it's our experience within the team, but it's then our wider experience because of these venture partners that we can bring to bear in supporting companies when we have invested in them. And what is it that we do invest in? And as Paul said, it's technology companies, but we want them to look like that. The growth, it should be something that can scale, not just linearly, gradually going up a little bit more year on year, but something where it can be a little bit more explosive, should we say, that exponential growth where it gives the opportunity for us to give clients the potential for a 10 times return on each investment. Clearly, they won't all deliver that, but we want them to have that potential to be able to change their scale by at least an order of magnitude. The stage is also very important for us. So not only do we want companies with the potential to have that trajectory, but we need to be careful when we come in, and we avoid this very earliest stage over on the left here, where it's maybe an idea they haven't quite got the fit in the market yet. We want to see as a minimum the evidence that these founders are capable of delivering and delivering at pace. We want to see the evidence that there is demand, commercial demand for what they are selling, so that there is evidence that people are willing to pay good money against all the other things they might want to spend the money on the product or service that this company is willing to offer. And at this middle stage, what we call product market fit, this is around, as I say, having a product that people, an identified market, wants to buy. And it's really important to have that evidence, because this first stage on the left can be very iterative. You're constantly trying new things. Is this going to work? And maybe you haven't quite got the right product. Maybe you haven't got the right people to target with that product. You have to iterate around on both until you get this point where suddenly people know that what you're offering is still really rough around the edges, but they want it, because it gives them value and it addresses something that is actually very important to them, not just a little nice to have. And so this is the stage we target in the middle with our EIS, where it's still quite early on. There's a lot of work to do. You've got to build up a team. At this stage, it's typically the founders and maybe a few others, and everybody's pitching in, doing everything. but that doesn't scale. You've got to start building out a proper structure to your business where you have dedicated sales team who are selling it. You've got people who are supporting those customers that you've got on. From an engineering point of view, I know full well from my experience how frustrating it is when you want to be developing all these new features and all your time's getting sucked into, handling questions or bugs on the existing product, and so you need to separate those out. And so you've got to do this, sort of create this whole business. But the advantage, of course, at this stage is it's a relatively lower valuation. So the money that we put in buys a bigger part of the company, and if it goes on to do well, it gives you much bigger returns. But eventually you move beyond that and you get to the scale up stage, which is what we target with the VCT. And so this is where you've basically you've got these building blocks in place. You've proved that you know who you're selling to and how much it's going to cost you to sell to them and to support them. And you need to put more money in order to be able to scale and to get that really sort of explosive growth. And that's the stage, as I say, we target with the VCT. And one of the nice things for the VCT is, one of the routes we can get companies is from our EIS portfolio, because we've then worked with these companies over probably quite a long period of time. We know them much better, and we can see which ones really having that potential for the future and which ones aren't. So it's this is all high risk, as Paul said, but it's slightly lower risk at this VCT stage. The reality, of course, is it's never a nice smooth upward curve like that. I know from the companies I was involved in, some of them did exceptionally well at the end, but they all had their very squeaky moments where things could have gone badly wrong, and they maybe had to, I can certainly in one case, had to cut back on people. It's not a smooth journey. But this is long-term investment, and you expect that. And similarly, there's no sort of a definitive dotted line that you can cross with a company and say, oh yes, this is now VCT rather than EIS in our terms. And so we do have a co-investment between the EIS and the VCT. It's as I say, it's a little bit more vague, but that gives you the indication of the stage that we avoid, the stage we target with the EIS, and the stage we target with the VCT. We diversify over that stage. We also diversify by sector, which is very important. And we go for a very, very broad range of sectors. We're often asked, what are the really interesting areas at the moment? And we have three what we call themes at the moment that we think are particularly interesting. We do absolutely look at everything that comes in, that fits that tech mandate. But these are the ones maybe where we think there is particularly interesting potential. And they are the energy transition, deep tech, and fintech. And the energy transition is all about decarbonizing energy, not just energy generation, but the use of energy, particularly in buildings, transport, and industry. And so transport, it's not just cars, it can be ships as well. We've got a nice company that is involved in reducing fossil fuel use in shipping. And it should be clear, this isn't, interesting because we think, oh, it's nice, fluffy climate technology. Yes, it does help the climate, there's no question. But from an investment point of view, what's really exciting is that a lot of these technologies have now reached a tipping point where they are more efficient, more cost effective than the fossil fuel technologies that they are replacing. And that means there is this huge shift. I mean, just look at how China is deploying renewable energy now. It is on such a big scale, and they are not doing that because they want to help the climate. They are doing that because of the economic benefits. And the economics of the energy transition mean that there is an awful lot of money to be made in supporting this transition across to these renewable sources of power. So that's one. Deep tech is really broad, and it's really about things like university spin-outs where it's really techy. So you've got typically some patents protecting some underlying innovation that fundamentally changes what is possible to do in the world. And for those of us with a sort of a more academic background, it can be very exciting from that point of view. But again, a lot of these companies, because of that protection, they are the only people who can do what they are doing. That means there's long-term growth potential, and some of these companies can have the potential to scale to be extremely big and very, very valuable. So that's the deep tech. And then fintech, actually, if you like, a narrower theme here. This is one sector, the financial technology, and it's something the UK is really good at, and we have this particular ability in the world to create valuable fintechs, and there are certain sort of principles, if you like, in the way finance works that means it's possible to actually again get these very high returns, big growth, because it's all about lots and lots and lots of transactions, even if you're only taking a tiny amount on each one. And I will give you an example of that a little bit later on. So 3 themes where we think there's particularly interesting potential for returns. And they're also interesting for us because we have particular expertise in them. So the energy transition, Blackfinch has its energy team running renewable energy resources, solar farms, wind farms. We have a dedicated director for energy transition. We have our property team, which obviously helps when we're talking about energy use within buildings. And we're starting to build up a portfolio of companies there as well. And the real advantage of that is that we then have greater credibility in attracting companies, and we have greater expertise to support them when we have invested in them. So it works both ways. We get better companies coming to us, and we can support them. And that's why we like to promote ourselves to founders, with these 3 themes. Similarly with deep tech, our PhDs in the team. I was talking to a company just a couple of weeks ago in Oxford. It's a spin out from the university there, and they said how nice it was, talking to an investor who understood science. We didn't understand the fine details of the work they'd done. That's not our subject, but we understood the principles of science. They could relate to that. They could see, oh yes, we're a good investor. And also mentioning we're not coming in with big egos telling them what to do. So it's again that credibility with founders. And fintech, I mean, we obviously play in the the financial markets ourselves, and Blackfinch has always had a very, very strong internal technology team, providing tech that we use internally, and we're even actually now starting to offer some of that externally. So again, something that we can bring the right people in to talk to companies so they understand that we understand what they're doing and what they're going through. So those are our themes, what we're looking for to invest. And the next point then is, how do we invest? And this is our process, 7 stages that we go through. And it all starts with deal flow. Where do we find these deals? And it's universities, accelerators, incubators, referrals from our network. Actually, interesting, we're getting increasing numbers of referrals from other investors as we've become more established over the last 6 or 7 years. Which is very good. So we get those. People just send us their information. Again, we've been out there a while. We've got a website, and then we go out looking for them as well. So we always promote on LinkedIn, trying to get companies to send us their information. They come, and we use also more specialist research tools to go and look for companies. So we approach them directly, and we've found some very interesting companies that way, getting again ahead of perhaps the point they were going to go out to the market, and therefore giving us a sort of an edge over other investors who might want to invest in them. So that's the deal flow. And then we go into these various stages to filter it down, because we see typically at least 1,000 companies a year at that first stage. And we're only going to be making in the order of 10 investments a year. So we've got to really filter it down quite quickly. But as I said, we work very collaboratively as a team. and it is a team decision to move companies from one stage onto the next. It's not down to one individual. It's not me going out finding my investments and then trying to push them through. This is very much, as I say, we're all working together. And one of the things we particularly do is keep the more senior members of the team out of talking with the companies in those very early stages, because we want to look at them objectively. And so it tends to be one of the associates who has the initial discussion with the company, collects lots of information, then the associate presents to the rest of us in the team. We have a daily call where we're talking through any new opportunities. And they it's only after that we start to engage other people with the company. And really for us, this is going on to stage 3. The pitch is really quite fundamental, and it comes later in our process than for a lot of investors. Normally, that's the first thing that happens. And if a company is lucky, they get to do an hour's pitch, to the investors. And the trouble is with that, though, founders get very, very good at pitching to investors for about an hour, and they can make it sound amazing. It's all really glossy. They tell all the good bits, and you don't see everything that's underneath that's not quite there yet, because by definition, every early stage company is a work in progress. There are always things that aren't there yet. It's a question of, are they fundamental, or are they things that they just haven't quite done yet because they're still working on it? And so we have our pitches typically 3 hours. I think our longest was actually over 5 hours, but typically 3 hours. And we've quite heavily qualified them at this point. We're putting multiple senior members of the team in with the company to really try and understand their business. And when the company understands that, it's not too daunting. They sort of open up. They realize our background. They get the idea that we've been founders. We know what it's like. And so we can get this really good picture of what the business is really like, and whether that's appropriate for us and for our clients. After that, if we like it, we take it for the first time to our investment committee, and it's not a hard decision point. This is more guidance, getting input from the investment committee and any other experts we think would be appropriate. Because clearly we don't want to go on and sign a term sheet with a company if the investment committee is not going to like it further down the line. And they're also quite good at coming up with just making sure we've covered off the main risks, things that we'd need to check during our due diligence. And that filtering stage, we usually bring several companies at the same time, which allows them to be compared side by side. And it's very interesting for us actually to compare these companies side by side and pick not just ones which are good, but which are the best ones at that point. Going into the due diligence, we try to do this quickly because that helps keep momentum on a deal, and making progress for the company and not distracting it too much from its core business. But we have to make sure, and we do make sure, it's very thorough, and we're getting in experts on technology, on finance, on the legal side of things, and of course on EIS and VCT status. For EIS, we make sure there is advanced assurance in place from HMRC, and we get an opinion from an appropriate specialist with professional indemnity insurance to guarantee that, yes, the company is EIS qualifying. And we get a similar opinion for any VCT investments, again, to make sure that they are absolutely qualifying. You can't get the HMRC doesn't like people going for VCT advanced assurance in the same way, but the process is a bit different anyway, and we do get that opinion. So we are absolutely certain that all the investments are EIS and VCT qualifying when we make them. Then, providing nothing's come up in due diligence, occasionally it does. We have on odd occasions dropped something in due diligence. Normally it's just, well, you uncover a few things, you understand the risks, and you can manage those, and it's fine, and we can proceed. We go into obviously the final investment committee approval, very important, and we have the legal documents, and the legal documents will give us terms, for example, to ensure that the company will maintain its EIS and VCT qualifying status after we've invested, we have consent rights to be able to, for example, block the company being sold without our approval, or to issue more shares, which would dilute our clients. And very often we expect there comes a point where the company does want to issue more shares or does want to sell itself. And that's all fine if it's in our client interests, but we have those rights to be able to stop things happening if they would not be in those client interests. And then finally, we go on to the monitoring and support, because actually making the investment is only the start of our journey, not the end. And we expect to have companies in the portfolio for, as Paul said, typically 4 to 7 years. And that's where we have the board observer rights, and we review every company every month within the team to see what more support we can provide. And we have, in nearly all cases, a venture partner on the board, again, adding their value. Looking after clients is also really important after we've invested. And one of the elements of that is valuations. And we value companies on a quarterly basis in accordance with the IPEV standard industry guidelines. And for added comfort, the VCT, not the EIS, but the VCT is audited annually. And we, as I say, the EIS isn't audited itself, but particularly where there are co-investments, we're using exactly the same process, the same numbers to come up with the EIS valuations. And so we give clients these quarterly updates, even though, particularly, for example, for the VCT, the main publications are the annual report and the half-year report, but clients get these interim quarterly ones as well. So how's it going? Actually, pretty well. This we launched. I'll focus on the VCT simply because it's public data and it's one portfolio rather than the EIS where we have lots of small portfolios. But you can see we launched in March 2020, just as the country was descending into lockdown for COVID, which we wouldn't have chosen with hindsight, but we were there. We just got the money we needed to launch at £3 million. And clearly at that point, we hadn't made any investments. We were incurring costs, and the NAV per share dropped down, actually hitting about 89 pence in September 22. But by then, we'd continued to raise money. And then the performance of our investment starts to pull up and, counteract all the costs. And so we've continued going up, so that now, actually, we have a total of £64 million assets with a NAV per share plus the dividends, because we've just started paying dividends, 106 pence. We have actually paid now 2 full years of 5% a year dividends. But the good news is, because this NAV plus dividends is only at 106 pence, there's a good sort of 23 pence to go before we hit our performance fee hurdle of 130 pence. So there is no performance fee going to be taken on any of the increase up until that NAV plus dividends hits £1.30. So plenty of growth there before we get our hands on any of it. That's the 5% dividends, as I say, for the last 2 years. That is our target of at least 5%. Our official target is 5%. But you can see we've made sure we slightly exceed it rather than fall short in the last 2 years. Therefore, you can see of the total value, more and more of it is starting to come out as dividends. And if we put Q3 on there, there would be the August dividend also showing, which would be, so there'll be a little bit more, of that darker color at the top. We have, that's interesting, sorry, excuse the slide here, but this is supposed to be our portfolio for the VCT, showing the diversification of lots of different sectors. And this is all the different sectors. We've got 35 companies in the VCT, everything from wellness, technology, HR, things powering the digital economy with digital marketing, but also a lot more tangible things like construction technology, for new buildings, or even space technology. I'll give you an example in a second. So that's the VCT, and there is something similar for the EI. Though this one's shown properly. It's a very similar set of sectors to the one we had on the VCT there, slightly different proportions. Obviously, yeah, as I say, with the VCT, you are buying into the existing portfolio, and then you're also benefiting from new investments we make. Whereas with the EIS, each client gets their own portfolio of at least 10 companies. That's how we spread the diversification there. And so you wouldn't be buying into the existing portfolio. This is just an aggregate view of everybody's portfolios as they are at the moment. And then to give you some examples before I hand back to Paul quickly. First of all, if you ever go abroad, get one of these. It's a currency card. It is a travel debit card. It is brilliant. It is much better than all the others because you do not need to transfer money into a separate account. It links to your own bank account and you can pay on it like paying out of your own bank account without all the fees and extortionate charges. Even more excitingly, they are now powering the world's first loyalty debit card with Hilton Hotels. And it's attracting a lot of interest from other big international companies that want to offer loyalty debit cards. Because again, their debit card works with any bank, and so it's not about having a separate account. And so that's very exciting potential there. Our newest investment, this is VCT only, this is SpaceFlux, and it's tracking what's in space, and it can track things down as small as 2.5 centimeters across, whizzing round, and it's getting increasingly congested in space, not just with satellites, but all the debris from, failed satellites and other things going on up there. I had no idea space was so aggressive, but apparently these satellites are moving around all the time, looking at each other. And SpaceFlux has got some very nice contracts with the UK government, with Space Command and others, just tracking what's going on up in space. And then finally, Spotless Water, which is supplying pure water. Window cleaners these days don't need lots of soap and then squeegees to clean your windows. They just use ultra pure water, and they just need to rub it over and it takes the dirt off and doesn't leave streaks. It's much, much quicker for them, but it's a big hassle for them to have their garages full of equipment to generate pure water. Spotless Water has essentially converted shipping containers in locations around the country where you can just fill up your van with ultra pure water. It's like a sort of petrol station. You pay for what you use and there's an app that goes with it, but it's pure water. And they just keep rolling out more and more stations, and that's a business that we've had a while now, doing very, very nicely. And with that, I will hand back to Paul.
Thanks, Nick. Thank you ever so much. Really appreciate that. It was a good insight into some of the portfolio companies. That's just a snapshot of those impressive companies. So, listen, we're coming to the end of the presentation. Why would we recommend investing in the Spring VCT? Well, as one of the newest VCTs to market in several years and one of the youngest, we are dividend yielding now, which again is critical for some of your clients. So we are now paying regular dividends. We do have a higher than normal performance fee at 130p, some are at 120, and as Nick alluded to, we're quite some way off achieving that. We do have a strong performance for our VCT, we certainly do, over a 1, 3, and 5 year time frame. So strong performance is one, but again, having that differentiated approach with founders, people who have actually ran tech businesses themselves, is a differentiator for us in comparison to others. So that team of founders, the team of non-executive directors, absolutely should be a consideration when you're looking at VCTs or potential VCTs for your clients. Why invest in the EIS Ventures? Again, the same team, it's the exact same ethos, the exact same deal flow and process that we go through to look at these particular companies. But again, one of the ways that we differentiate ourselves is having that ability to take monies and applications later in the year, right up until tax year end, right up to the middle of March, in order to have that deployed before tax year end. People don't really like the administrative burden of potentially 10, 13, 14 EIS3 certificates coming through. You could do it all at the one time and ensure that your clients are served from an administrative point of view. Again, we target quite a high number of portfolio companies, typically 10. I think maybe a year or so ago, about 14 we had in tax year end. We invested into 14 companies. But again, that value add of the tech founders, the non-executive directors, and the fact that our AMC is not taken in perpetuity, it's only for the first 4 years. So again, those would be the compelling reasons that we would differentiate ourselves in order to be considered for your clients' EIS and VCT needs. Now, just to kind of wash up here, the learning outcomes. So we've looked at the different structures, so VCT and EIS. So hopefully now you feel more confident in explaining what the differences are structurally and why you get tax breaks, certain tax breaks with one and not another. You can now explain how deployment works between the two, and again, impart that to your clients when you're making recommendations. You should be able to identify those salient clients that would be applicable for, and now understand how we approach the market and the types of companies that we are looking for. We have further resources. This is literally just scratching the surface of what we have available for our advising clients. We have a multitude of resources on our website, but again, you can just reach out to people like myself or your local BDM, and we will give you all the help and assistance that we can. All you need to do is just drop us a line or go into the website and see what's available for you. These are some of the resources that we have. We have insights, we do webinars, we have market updates, we've got absolutely everything that you would ever need, and all the help that you can get from us. So with that, we really appreciate your time. Thank you ever so much. Hope you all have a great day and enjoy the next week up until the blockbuster budget. Take care. Bye-bye.